Ladies and gentlemen, welcome to the first edition of the Investor's Journey podcast. I'm your host, Josh Klein, and we have here Yaakov Loboda. Yaakov, welcome.
Yeah, thanks, Josh. How you doing?
Doing great, doing great. So Yaakov is an incredible real estate investor. He's been in the field for nearly 10 years, various jobs within the industry. We're going to learn a little bit more about his background, where he's working right now. But Yaakov has a unique perspective from both the debt side of real estate as well as the asset management and acquisition side. So we have a really unique perspective that I'm really excited to talk about. So Yaakov, if you mind just starting up, talk about a little bit about your background, how you got into real estate, and what you're doing today.
Sure. It started obviously like you. I went to college in YU. I didn't really know what I wanted to do. I actually was leaning towards trying to get a job in sports. I had various phone calls. The biggest thing I did was have a phone call with a scout with the Dodgers. I thought that was definitely like my coolest interviewing experience when I was at that stage. Then as I was going through the process more, I realized that it really wasn't an industry that was realistic. So I wanted to start pursuing things that made a little bit more sense for me. My family was in real estate since the 1960s, from both my mom and my dad's side. So it was always something that I was familiar with growing up and something that I was exposed to a lot. So I decided that I would start looking more into doing something in real estate. And it took me a while to find something right after college. I did have some internships that were relevant. I worked at a big real estate company in Los Angeles over the summer of 2016. But I couldn't find something that was really calling to me. So I just needed to get my feet wet, and I started with Brokerage. I worked at this company called KSR, and I was an investment sales associate with them. They focused more on New York real estate at the time, but it was very good for me to just speak to people constantly, cold calling people all day. And I got to just learn from a lot of different people, and it was a very good experience for me in that sense. But I realized that investment sales, brokerage was definitely not my calling. So one of the investors I did speak to, his name was Ruben Kahana. He actually asked me if I wanted to come under him and help him with acquisitions and underwriting. And I actually had no experience in either of those fields, but I thought it would benefit me heavily to do something like that. So I did that. And then while I was working with him, I decided to go to NYU and get a master's in real estate. The pandemic happened. I stopped working with him. I continued school, graduated school. And then once I finished school, I started working at Dwight Capital. A friend of ours actually brought me into Dwight Capital. And I was a little bit hesitant to start working at a debt firm because I was always like, in the back of my mind, I'm going to be working on the equity side. I'm going to be an investor. I need to look at things as an investor. But something I realized pretty much at NYU is that if you can underwrite a deal from the debt side, you can definitely underwrite the deal from the equity side. So if I learned how to do underwriting on the debt side, I wouldn't have any issues, transferring those skills over if I wanted to be on the equity side.
Wow. Fascinating, honestly. So I guess as you've transitioned, like you mentioned, from the brokerage side, just getting exposed to the industry, to going back to school, getting a master's, and then debt, and now equity, how has your mindset shifted in terms of just your macro outlook of real estate, how you look at a deal, because you're really pulling different strings and different components of your background to leverage that and to succeed. So how has that really shaped the way you look at real estate today?
Well, something I realized, there's a lot of things I realized, but something interesting I realized is everyone has an agenda on the deal. The broker has his agenda, the lender has their agenda, and the buyer has theirs. And on the buyer side, there can be multiple layers. There could be the GP, the LP, and they have their own agendas as well. So just trying to mix everyone's expectations and balance it is definitely tough and something that I expected or something that I learned. Another thing that was also something that I realized, especially when working at Dwight, I realized that the debt is just as much of an asset as the asset itself. You if you locked into an interest rate of like sub 3% during 2020 2021, that loan is the biggest value of your property at this point. Where nowadays, you're dying for interest rates to be like that and get a loan like that. So I found that fascinating. Also, utilizing amortization, huge asset within the asset itself.
Yeah, it's a good point. And just going back to the actual real estate academic side of your experience, working and then learning, obviously at NYU, how has the academia impacted the way you see the actual practice of real estate? Were you prepared to get into the field and work for Dwight, underwrite deals, or was a primary driver of your success just learning on the job?
I think it's a little bit of both. A big advantage of NYU is the relationships that you can make at NYU. You meet a lot of people that are doing various different things within the industry, and I do feel like there were some very helpful things that I did learn, and they push you to use certain practices while you're either doing reports or taking a test or whatever. But I wouldn't say that it's the academia portion. It led me to have success while working. I learned a lot of what I did on the job because a lot of the things that you do on the job are very niche to that specific job that you do. And I was working at Dwight, which is a HUD lender, and HUD lending is a very niche product of lending. So, I wasn't learning about HUD specifically when I was working or when I was at NYU. Something that I did learn though, or something that they made me practice was underwrite a deal from the lender side and be the lender on a deal. And why would you look at it and wouldn't look at it? So I had to, learn a little bit of the capital market side, which, kind of gave me some background and helpful background to what I can do at Dwight.
Yeah, it's a good point you're making, especially if you know what drives the debt of any particular project, you'll know what drives the equity as well. And if debt doesn't work, then the equity is not going to work either, and the deal is going to die. So you said about an asset being these property owners that own a 3% or owe a 3% mortgage or sub 3%, and then now you talk about interest rates that are in the sixes, maybe for HUD products a little bit lower. So there's an advantage to that, but there's also a massive disadvantage. So what do you think in terms of your portfolio at Loboda Properties? And you can go into a little bit more specifics about some of the nature of the debt you guys own on those on those properties. But what do you do when you own an asset that has a loan of say 3%, and then all of a sudden you have to refinance and you're faced with a much higher interest rate loan that might not necessarily take out or really refinance the entire portion of your debt? What do you do about that?
Yeah. Well, I'll say a good thing about the majority of our portfolio is that it does not mature, or none of the loans mature for a while. Now, when I was saying that, I was probably being very specific to HUD because when I HUD's a 35-year fixed. So if you have that loan for 35 years starting in 2020, that you're not worried about what interest rates are going to be in 2055.
Hmm.
That's just it's too far down the line. A lot of our loans aren't due for a while. I haven't been involved in any of the refi processes at Loboda Properties yet. I have been here for a few months, and we obviously have not refied. Um, I can't tell you what's going to happen in 5 years and what we think we're going to do, but I can tell you now when we look at new deals for the debt on those deals, we either look at assumable loans or if we can afford it, we'll go all cash. Uh, and the reason being is that if we can go all cash, when the time comes that we feel that rates are in the proper place for us to refi, we'll refi, and then we'll use that cash out to go and pursue other deals. Or if we go assumable loan, we would be willing to spend a little bit more on that deal if it pencils for us, and that's a big advantage for people who are locked into those three rates, 3% loans. You can sell them as an assumable loan, and people that's an attractive deal to people because they have no other option.
Do you ever see, when you see opportunities of sellers wanting to sell an assumable loan property, like you mentioned, you have a loan in sub 3%, 30, 35-year fix if it's a HUD product, and they want to sell it. Do you view that a little bit as a red flag, thinking, why is it that the seller is now selling this product, this property that has such an attractive debt on it and can really just clip cash flow for the foreseeable future?
I mean, it could be, but that could also be overthinking it. They could really just be trying to take advantage of the opportunity to, get an extra, $2 million on the deal because they have an assumable loan. So they might know that they can take advantage of that situation. But yeah, there you can also think of it the other way. Maybe there is a red flag, and then you have to dig a little deeper in the underwriting and try and see if you can find it yourself.
Yeah, yeah, that's a good point. And just going back to your experience at Dwight, so I know you led a team over there specifically on sizing and figuring out essentially how to quote out deals, how to underwrite the actual loan amount, working through the property due diligence, sizing them and whatnot. So when you look at a specific property, what are some key, I guess maybe challenges or key maybe red flags you look at when you look at a particular sizing? Is it you're looking at the property trailing 12 expenses? Is it more of a focus on the area? So said another way, what are the key drivers that could impact a loan's amount and rate and your willingness to do it?
So the main difference between a commercial bank and a private lender, uh, I think the bank would look at when they underwrite a deal, the the sponsor. They're going to look at the credit of the sponsor, who they are, and all that. But I was at a private lender. What we focused on more, and this is what really HUD focuses on, is the deal itself. Especially like if you're looking at it like a stabilized deal, um, you're going to look at the actual cash flow, the DSCR, the location of the property, really the fundamentals and the basics of real estate. That's really what they're going to be looking at. And for me, like when I looked at I looked, like you said, T12. I was looking at T12s. If the cash flow was, you know, properly hitting that DSCR, then it would be a deal that most likely ended up being a cash out for the investor if interest rates allow, and it would be a deal that is more likely for the investor to pursue with us as a HUD loan.
Interesting. So, what do you think over the course of the HUD process? Because some of the positives of a HUD product is, like you mentioned, 35-year fix, low, typically lower interest rate than other agencies or other bank products. But one of the downsides is that it's a very long and tedious process. Sometimes could take up to a year to close a HUD loan. So, what would you say are some of the challenges in getting a HUD loan closed? And of the HUD loans that you have closed or you have seen Dwight close, what are some things that successful operators have done to ensure that they actually reach the finish line?
So I personally wasn't involved as much in that process. I was really, like you said, sizing. So we were the upfront. I saw every deal that came into the in whether we close it or not, or whether we signed it up or not. But I would say like the big challenges have been historically things like reserves. You have to keep things in reserves and larger than Fannie Mae or Freddie Mac. Um, the long HUD queue was a bigger issue in 2020 and 2021. 2022 and 2023, that queue went down because the demand for a HUD loan uh, obviously changed with rates. So it still took a while, but it'll still take a while, but it's gotten a little shorter now. The process, uh, the underwriting. a lot of times a reason why a loan wouldn't close, I would say, is a sponsor's inability to get with his feelings. And I being on the investment side, I understand it's hard, but if they are patient and willing to play ball, you know, a lot of times the deal will close. Now, a big part of my job was to make sure that I didn't let any deals that I know HUD wouldn't like fall through the cracks. For example, HUD has restrictions on environmental things. So I had to check on the environmentals of the property before we even looked at the cash flow of the property. I had to make sure that it's not in a floodway, or I have to make sure that it's not in next to certain power and environmental red flags. So those are just things that I had to make sure that wouldn't fall through the cracks, and therefore, like, it wouldn't be an issue with HUD.
Hmm. So of the deals that you've been sizing, so you mentioned you've seen all the deals. Kind of, you were the first line of defense, looking through
Mm-hmm.
to see if it's worth twice while, if it really would fit the HUD bucket. Were there certain trends that you noticed amongst the loans that you were seeing? Obviously, and you mentioned interest rates have changed pretty dramatically, but in terms of the size of the deals you were seeing, the typical geography that you're seeing a lot of deals come in from, do you see any trends that you noticed while you were at Dwight?
In the beginning, I would say it was very cookie cutter, very like easy, brainless work. They gave me a stabilized deal, put in the numbers, the deal will pencil. It wasn't complicated, low interest rates, whatever. The existing maturing debt was higher than what they were expecting. Over time, a lot of bridge loans were coming to mature, and they were looking to refi, and a lot of these deals were cash to close. So a big trend that I saw was a lot of bridge loans won't work as a HUD loan or any permanent financing, and a lot of those borrowers were probably going to be put into a position where they had to make a deal with their bridge lender or they had to sell. And more and more of those deals are probably coming to fruition. And we haven't bought a property in the last year, Loboda Properties. So I think that if we continue to stay patient, a lot of deals will be coming, into the market, especially deals that have been recently value add, you know, and currently stabilizing. They just can't; those owners cannot find permanent financing. So there'll be a good opportunity for us and probably a lot of other people that didn't take out bridge loans during uh, the pandemic and are in a good position.
Yeah, it's interesting you say that now because I just saw a quote from the CEO of Brookfield Asset Management. He was saying is that the opportunity that they see, it's really twofold. There are bad assets that are just in a troubled time frame right now. It could be offices, maybe hotels, maybe malls, and those there will be opportunities there, but the opportunities are not as widespread as the second bucket, which is the bucket that they said they were going to invest in, is trophy assets, quality assets with poor capital structures. And that's exactly what you're mentioning here. It's that anyone who really took out a bridge loan or essentially did a pro forma or an estimate of a value add and was anticipating being able to carry higher interest rates and then refinance at lower interest rates with a HUD product, a bank product, or something of the like, are really just not penciling out anymore. And those are going to be quality assets at unfortunate, good for the buyer, dirt cheap prices, but unfortunate for the seller that potentially at a loss. So moving over to Loboda Properties, when you look at potential deals or even how to manage your existing properties, I know that you guys have around 50 properties, and you mentioned you haven't bought a property in the past year. Are there key states? Are there key areas, types of assets, or specific opportunities, criteria that you look at when you want to purchase a property?
So we've always been pretty conservative with the way that we go about our business. I'd say the entire portfolio is probably around 50% levered. So it's a pretty healthy portfolio currently. When it comes to where we look to buy new deals, I don't specifically on the multifamily side. I wouldn't say that there's a state in which we're like very much for or against. We try to target areas that have strong demographics. On the income side, population side, whatever. We have to believe in the area itself. So location is important, but it's not the number one thing. 1985 or newer, we don't want to have to put too much work into the deal. Light value add is fine. Over 100 units. If we're going out of the state of California, if we're doing LA, which we haven't done in a while, obviously that the number of units change because we can self manage a lot of those a lot easier. Mm-hmm. When you do out of state management, 100 units or more make a lot more sense. And then on a cash flow basis, like we want to be able, let's say we're exchanging, we want to be able to, at least bring up our cash flow a little bit. People look at percentages and stuff like that, but a lot of times it just matters. Like for us, there's a deal that it's only a 4% return on our investment. But if you're really looking at it from the exchange standpoint, we can be doubling our cash flow. And that, if we go from 25K to 50K a month, it's a big deal. Mm-hmm. So that's a lot of our mindset, especially on the exchange side. And recently we've been trying to look at diversifying a little bit on the portfolio. So we've invested, the most recent investment was a triple net single tenant industrial deal. So non-multi, Michigan. We have 2 multifamily properties in Michigan, and this is our 3rd property in Michigan. But what I like about it is the triple net factor. There's really not a lot of work for us. Mm-hmm. The only thing that was scary for us is that we had no experience in it. So we had to hire some outsource some underwriting, something that you're familiar with. Mm-hmm. And to help us just understand the deal. And it's been a year, but it's been good. And I want to continue, since I'm here, I want to continue helping them decide what properties are our quote unquote dogs, who are the losers, who should we be getting rid of, and where should we be exchanging that money into. And I think that continuing to diversify into newer asset classes, and utilizing, like I said earlier, all cash or assumable debt deals for multifamily, those are the type of things that I think we're going to be transitioning to hopefully in 2024 and 2025.
Wow. So with the industrial properties, I know you mentioned the vast majority of your experience, I guess both you personally and also the company, is more on the multifamily side. Obviously, the industry we're in right now, the macro environment is drastically shifting, and not all asset classes are created equal. So when you think about diversification, is your goal really to just move to an asset that has the highest upside, maybe lowest downside risk exposure? You're familiar with multifamily. Are you looking into mixed use, maybe some hospitality, retail, or is it really just whatever opportunities there, whatever you feel comfortable with, let's go for it?
I mean, everyone's goal is to make the most money and also have the least amount of risk. It just those two things don't always go hand in hand. I think we're more risk averse. We really, like I said, we're conservative in the way we approach things. We used to, I would say in the beginning, my grandparents started off doing retail, land, and multi. Those are the 3 things that we focus on. In Los Angeles, we still have 5 retail centers that we still manage, and they're still doing well for us. However, when we were investing in out-of-state retail, that's when it started to get a little bit a little bit more dicey, and we realized those weren't winning deals for us. So we moved on to the multifamily side more, I would say, like 10, 15 years ago. And that's been our main focus and what we focus on the asset management side mostly. But I would say that we're done with the retail approach, especially shopping centers, anchored shopping centers. That's not things that we focus on. We're more likely to sell one of those type of properties than buy those type of properties. But something that we feel that is Amazon proof
Mhm.
is, fast food triple net deals. So those are the type of deals that, if we can't find an exchange on the multi side, those are sometimes our fallback plan B options to go, okay, is there a 12-year lease KFC, on a busy highway anywhere? That's the type, because those deals are more available than those deals are always available.
Mhm. So
Um,
what kind of cap rates do you see for some of those deals that are maybe risky in the sense that it's a single tenant, but also not as risky because you have a quality nationally recognized tenant with a
mhm.
long-term lease? So are you seeing lower cap rates with those type of products than you would on the multifamily side, or pretty comparable?
It could be pretty comparable. I mean, I usually see or target 5.75 6% cap rates on those. Now it's tough if your debt's over 6%, you can't really make any money on that. Um, so like a lot of times the target is that you're able to exchange a deal and potentially go all cash on that type of deal, and then if there's the proper rent bumps in the lease, maybe year one you're at 6% cash return on your deal, but hopefully that grows to 7-8%, whatever, and it's just a stable, easy place to shell some money until you're ready to hopefully maybe exchange it to something bigger and better.
Right. And then of course you have the added benefit of maybe interest rates falling in 5 or 10 years, and you can sell it
Right.
at a better cap rate.
Right.
That's an interesting way of looking at it. I guess really just to wrap up, I'd like to know your opinion on, because like we talked about over the past half hour or so, you've had a lot of different types of exposure to the real estate industry. What kind of piece of advice would you give to someone who's looking to break into the field, and just learn what resources maybe they should look out for so they can better themselves for the real world?
Well, uh you should definitely be patient, because I had to be very patient. So my number one advice would be patient, because it's not just going to happen for you overnight. This is a long, long, long game, and I'm still in this beginning of this long game, as are you and many other people that we know. Um, you should probably set up unrealistic goals, because the most successful people probably have the most unrealistic goals. Um, and if your goals are super unrealistic and you only reach half of what your goals are, you're probably a very successful person.
Right.
um Being adaptable is extremely important as well. I had to kind of like maneuver my way into doing many different things, not just like, going from a master's program to brokerage to the investment side to the debt side, but like even when I was like within the debt side, I had to maneuver my way around, because like, rates are here now, rates are there, more people are targeting these type of deals, and now they're targeting these type of deals. So you just have to be able to roll with the punches. And then the last thing I would say is that you need to follow the industry like you follow your sports teams. That's kind of the analogy I like to use, because people, follow sports teams heavily. They know everything about their team. If you don't follow the industry that you're working in, so in this case, real estate, the same way, you will fall behind, because you won't know, the right next steps to take if you're not, you know, current with the times.
That's a great point. Got to be a lifelong learner if you ever want
Mhm.
to succeed in this field and in any field. Well,
Mhm.
Yaakov, thank you so much for your time. I really appreciate it. Best of luck in all your endeavors. Hoping it's going to be a great 2024 for you.
Thank you. Thank you. Thank you for having me, Josh.